This beef tends to be leaner with a sought-after flavour. Northland has a mixture of breeding and finishing properties. Some specialised beef farmers export frozen semen because of demand from overseas markets. There are 2 processing companies operating in Northland which process beef, sheep and calves. These modern processing plants can process about 1 beef side every 31 seconds, with around 175,000 beef animals being processed in Northland every year. Also processed are 123,000 sheep and 45,000 calves. Northland also boasts the biggest blast freezer in the southern hemisphere. Around 80 to 90% of production is exported. Products include a full range of vacuum-packed prime beef, bulk manufacturing beef, lamb and mutton chilled and frozen cuts, and veal cut during the calf season. Dairy farming is experiencing growth in Northland, which is distinctive with the ability to supply milk all year round from a predominantly grass diet. This allows farmers to take advantage of the premium price for milk in winter, when most of the rest of the country is drying off its herds. Northland's warm and moist climate produces all-year grass growth, which is unique in aiding this ability. With nitrogen, Northland can grow grass successfully in the winter. In a bad year, there are only about half a dozen frosts, which is a key point of difference for Northland. On average, Northland dairy herds calve earlier than any other region in New Zealand. With the cows starting their milking as early as possible, their milk production is peaking before Christmas, making the most of the optimal spring and early summer grass growth when it's most efficient. The dairy industry cow is predominantly Friesian or Friesian cross in Northland. Within the region, Fonterra has 2 milk processing manufacturing sites, producing about 151,000 tonnes of milk products annually. During the peak of the milk production season, Fonterra's 2 manufacturing sites can process about 5.1 million litres of milk per day and employ more than 430 staff in the region. Fonterra exports around 95% of local production to more than 100 countries around the world, exporting a container of dairy products every 3 minutes. Deer farming is a relatively new industry for Northland and an area with great potential for growth. The milder climate reduces energy for maintenance and warmth, letting more energy go into growth, which allows many weaners to be heavy enough to be processed well before Christmas. Venison traditionally reaches a much higher price per kilo than beef or lamb, and velvet has enjoyed a solid export market in recent years. Depending on individual needs, farmers fertilise mostly with lime, which is mined locally within the Northland area, and superphosphate, also produced locally. The sheep farming industry in Northland is predominantly Perrindale and Romney. These are the main breeds which produce good quality wool for the carpet industry. The low incidence of frost in Northland allows farmers to produce lamb successfully earlier than in the southern parts of New Zealand.
What if you could generate a new income stream just by simply loading...
The Northland climate's described as subtropical and is particularly suited to a variety of high-demand subtropical crops. There's a wide diversity of soil in Northland, allowing a huge selection of crops to grow that are suited to these favourable climatic conditions, and long growing seasons, also producing crops earlier than any other part of New Zealand. Northland receives high sunshine hours, over 2,000 hours of sunshine every year, a low incidence of frost and high rainfall. The area is also enhanced with its many pockets of microclimates. Northland's largest horticulture crop is kiwi fruit, and that's grown mostly for export. There are
start with the introduction now and put you on mute, and then once he's on, we can get going. Good morning, everyone, and welcome to NZ Funds Connects. I'm James Grigger, Chief Investment Officer for NZ Funds, and every week we're taking the opportunity to bring you a variety of perspectives on financial markets, financial advice, and developments here at NZ Funds. It is Monday, 11th of October. This morning we are pleased to welcome back to NZ Funds Connects Amir Makari, Founder and Portfolio Manager of Emerson Point Capital, and Siddharth Malhotra, Partner and Head of Business Development. Emerson Point was founded in October 2017 and is a long-short manager with a primary focus on three core sectors: consumer, TMT, and business services. Amir and Siddharth, thank you so much for joining us on a Sunday afternoon. It's probably the worst possible time with young families to take some time out. So look, it's very much appreciated. And look, we're stuck here in lockdown and or in Auckland anyway. The rest of the country has a little bit more freedom. So it's a great opportunity again to explore some of the partners we have and what they're up to, how they're managing money, what they're looking for in markets at the moment. And so thank you. So, but perhaps before we get started, it would be great if we could just do a, back to basics, actually, who is Emerson Point, some of your backgrounds, what your philosophy is, what your process is, just to give our listeners a recap of things. And then we can go into some of the juicy things about some of the stocks and some of the themes that you're looking at as we look into, close out the year for 2021.
Thank you very much, James. We really appreciate it. Appreciate all your due diligence and support, and happy to spend Sunday with you guys, or Monday morning in your case. I'm going to share our screen here so you can see the presentation, which may make it a little bit easier to follow along. Hopefully that comes through nicely.
Yeah, that looks good.
Okay, excellent. Well, why don't we start with just my background. So I'm the founder and CEO of the firm. Siddharth's here as well, and we'll go through the full team's background, but I'm the portfolio manager and founder of the firm. My background is that I started off at Bain & Company, the big consulting firm, and spent a few years there working with private equity clients and corporate clients, laid some great groundwork in seeing how a lot of C-level executives had to deal with big business problems. And that, I think, is a history that I've leveraged through my time in the investing world. And then from Bain, I joined Castle Point Capital, which was a long-short financial services focused fund. The gentleman that ran Castle Point Capital was Todd Combs, who's the currently heir apparent to parts of the investment portfolio at Berkshire Hathaway. And that was a very formative experience for me, and a good foundation was laid both on the long and the short side, because I was focused on shorting going into the financial crisis. Then I had the privilege of working at Hellman & Friedman Private Equity. This is the most recent fund H&F just raised was $25 billion. So just to give you a flavor for how well they've done, they've crushed it. And it was a fantastic place for me to join and spend a significant amount of time in some interesting areas. And then right before joining Emerson Point, I was at Canadas Capital, which was a Lone Pine spin out. So think of the sort of Tiger management lineage. And Canadas was the biggest launch in 2007 or 8. And I joined in 2010 and spent almost 8 years there. What was a very strong run for my section of the portfolio ultimately culminated in the founder of Canadas Capital, who was Mandel's right-hand man before he left to start Canadas. He actually invested over $100 million of his family's money into Emerson Point, and he didn't invest in any other folks from Canadas Capital. It was just investing behind me, who he witnessed it generated a lot of alpha on both sides of the book. And ultimately, through these experiences, it was a variety of GARP investing, value investing, and growth investing, a nice mix, and from some very well-known shops. And I'm very happy to say from all of these different places, I have investors. So out of our dozens and dozens of investors, we have representation from people that have worked with me. And I think that hopefully speaks volume, and the most significant of which was the over $100 million investment from the prior firm. But there's significant investments from across my experience. And so that's my background. James, any questions there? Or should I do team and then the firm?
Yeah, that sounds good to me. I was just reflecting on the Castle. I remember doing due diligence on you that many years ago now, and going, you always look at someone's background and go, why were you only a year at Castle Point? And then, and you sort of, I think we were reading about, the fund closed, and that's always not a red flag, but what's going on. But I think anybody in the entire investment universe, if they got offered a job to be work alongside Warren Buffett, would probably go and take it. Totally. Pretty amazing way to, I guess, launch yourself into the industry by learning off folk like that. What an amazing experience to get things started.
Yeah, it was great, and it was quite a formative experience. The main reason why, there's a point in the Emerson Point Capital name is me tipping my hat to Todd, who is a friend and mentor, and we still, he has to be careful what he talks about, because Berkshire can move a lot of money around, and it's obviously in the public eye, but we have a great dialogue, and it's impacted how we invest, and we bring the type of thoroughness, the humility, the deep due diligence that I think is part of that same mindset. So,
great. I hadn't, to be honest, I hadn't clicked until just then the point connection. So, yeah, what a great attribute. Anyway, I'll let you crack on.
All right. So I'll jump to the team here. The investment team has 5 people aside from myself. And I think what's important for any organization is that you have people that have experience and significant experience. So it's not just me, but it's a strong team, and it's people with really solid backgrounds. So, we have folks from some of the best universities and the best private equity firms and hedge funds in the world. So I'll let people go through this, but really happy with the diversity there of what we're bringing to bear, the strength and quality of the team. And I think at this stage, I think everybody's been working with Emerson for quite some time. So, we launched in the end of 2017. So the team is worked out, is a well-oiled machine at this point. And then the finance and ops teams, where Siddharth is a key member, that team is the day one team as well. And so it has been together for almost 4 years now, or no, 4 years actually, because it formed at that point. So a lot of stability, a lot of strength, great infrastructure to do what we're meant to do, which is coming to, this is an executive summary slide. There's a lot here. I would just highlight a few of the things that really are important. It's the stock picking philosophy, which is towards the middle of the page. We employ a rigorous fundamental due diligence approach. I mean, we're not trading, we're investing. We're spending a lot of time trying to understand the businesses, the industries, so that we can make thoughtful forecasts. And a lot of what we do is we spend time specifically around business quality and then management quality. And then we try to incorporate everything we're learning about these businesses into a multi-year forecast that is free cash flow based. And we try to be really thoughtful around incorporating things that we think are likely negatives. So for example, right now, or in recent months, people have been debating how much of a tax rate increase people should incorporate into models. I'll tell you, we've been incorporating a tax rate increase now since the election because of our view that is the appropriate conservative approach to take, is that someone has to pay for these deficits and debt. And so we don't want to be surprised when one of our companies or the models or the returns aren't there. We incorporate other things as well to be thoughtful around things, whether it's cyclical natures of markets. We don't assume that trees grow to the sky. We assume that everything is cyclical, that we will see a cyclical downturn, and that we incorporate that into our forecasts. And then ultimately, this last bullet point in the stock picking philosophy is we try to be versatile around GARP, growth at a reasonable price, growth and value. We're not inflexible in our views. I started off in this industry working with a value investor. I worked in private equity, largely with growth investors. And then I worked at this Tiger fund spin out that was mainly growth investors. Depending on the environment, depending on the quality of the assets, what you have to pay for things, where we see opportunity, we'll go to where the money is. And so I think that these are important elements of what we bring to bear. Ultimately, a few other things from this slide that can be just helpful from a high level is that we have about 740 million of AUM. This is after our day one launch in January of 2018 with a little over 100 million. All of the capital was raised over a 2-year lock. So very high quality capital base. And the results have been strong. So we have a few different funds. I think that it makes sense to focus on the long short fund here, but all of them, considering their exposures, have done quite well. And we can focus this conversation rather than going through performance on the specifics around our investing ideas, et cetera, because we want to look forward, not backwards, but we're very happy with our performance. James, I'll pause there. Otherwise, I was going to go through some examples of the types of stocks that we own.
That would be great. I think touching on performance as well would be great, just to give an insight, because I think that's definitely something to celebrate in terms of especially given what's gone on over the past few years. We're really pleased with how things have gone, and so just touching on that too would be great for our clients and advisors who invest alongside us. Excellent.
So this slide is showing the long short fund since inception. We've been running on average a 56% net exposure. So we're taking about half of the market risk, a little over half of the market risk. And towards the bottom of the page, you can see the returns. So that YTD column, about 3/4 of the way on the right. So 2018, we're up 16% when the market was down 4. 2019, we're up 14 when the market was up 31. Last year, we're up 22 when the market was up 18. And then this year, we're up 4 while the market's up 16. But in aggregate, as we look at the total return, we've on net of fee basis, we have CAGR'd at 15%, while the S&P has grown at 15.6. Now, we've been taking only about half of the market risk. And so as we think about our attribution or our alpha, we look at that and say, you know, we've deployed the capital in a way that's been protecting the capital, but still being able to keep up with the market despite, you know, a pretty tough shorting environment. So that's some color. James, is it helpful to go through the long side of the portfolio, which is our long opportunities, or is that unnecessary?
No, yeah, that sounds great. I mean, I'd love to go through that.
Okay, so this slide is showing long opportunities, which we still have the, you know, we've been raising a lot of capital in our long opportunities fund, and we were really excited about it. So this is the long side of the portfolio, and it's running a net an exposure of 96%. So we're not levering it or anything. It's just that, you know, we've got 4% cash and 96% deployed, and it's done quite well. I mean, if you look at the returns in 2018, up 11 when the market was down, up 35 in 19 when the market was up 31, up 34 when the market was up 18 last year, and up 9 this year with the market up 16. And in aggregate, net of fees, we've been up 119% versus the S&P up 72. On an annualized basis, 23% versus 15.6 for the S&P. And so I think that's, you know, this fund has gotten to about 240 million or 250 million with a lot of capital coming in the last 18 months. And we think it's a very exciting product. It's the long side of our long short book. So it's not a different thing that we're managing. It's just the long side of the long short book, and it's done really well. And this is a nice diversity of where we're investing. We also have a TMT focused internet and software focused fund that has only about 80 million, and that's done about the same as long opportunities, and that's this page here. But that fund is still being incubated, so maybe we can keep moving.
I mean, I guess what the differences in performance between the long, short, and long set highlight really is the amazing bull market we've been in over the last few years. And you know, we'll touch on process and thoughts in a bit, I'm sure. But does that give you an indication that, look, when things do become perhaps a little bit tougher out there with you know, slowing economic growth and things, then you'd really expect that long short fund to come into its own because of the fact that it can take different exposures and across, you know, stocks that you do a lot of work on, but just really don't think they'll cut it in the environment. Yeah, I mean, it's been a tough environment for short selling because the market has been so buoyant. It's, you know, it's obvious. In a down market like we saw in 2018, as shown on this page, we did really well. I mean, we made, you know, the long only fund was up, I think, yeah, it was on this page, it's showing up 10.7 and the long short was up 16. So, you know, in a down market, we made money on both sides of the portfolio. But since 2018, it's been a rocket ship. The S&P was up 31 in 19, 18, and then up another, you know, 16 this year. So that makes it tough. And
truth be told, most of the pain that we've taken on the short side was in 2019. We've learned a lot of important ways to avoid some of the biggest issues with the short book after 2019 that we've implemented in 2020 and 21. But to really get to the heart of your question is, and what's really important and exciting is, the reality is that the world is cyclical, that trees don't grow to the sky, that the environment will get difficult, and the long short fund helps preserve capital in a tough environment and can make money in a tough environment. And so, we'll have to see. We'll have to see how things evolve with the market. And I'm sure you'll ask me my thoughts on the market, but we'll be ready to attack as we see the whites of their eyes, so to speak, on an environment that's going to be less buoyant. And and you could argue that there's elements coming together now with the Fed taper plans, with some other elements of slowing growth potentially, that we could have that period sooner rather than later.
Great. Well, let's touch on what we, before I interrupt you, around sort of process, and then I'd love to get your thoughts on some of those things that you just touched on, because I think for us, long short, you guys are quite harsh on yourself. 14% when the market's up 28 or 30 or whatever it was, but you are half exposed to the market, so it's still an outstanding effort when you think about what your beta is. But I think that for us is still pretty much on par or close to outperformance. But when we think about what's going to happen over the next few years, having a long short exposure we think is really important. But let's touch on the portfolio and things, and then we'll go forward from there.
Sounds good. Well, I'll be brief with these other pages, but this page is just showing the some of the examples of the names in our portfolio. So, cutting through just some of the higher level characteristics of names, you'll see here that there's a variety of companies, from a business that is a tech business like ServiceNow to a business like Dollar General, which is a grocery store, or an auto company, or I would argue a luxury goods company, Ferrari, versus a media company like Live Nation. So you have a variety of types of names. Some names are in consumer, some are in tech, some are in business services, some are inexpensive. Sony trades at like a mid-teens free cash flow multiple, and some names trade at mid-teens revenue multiples, like ServiceNow. So there's, as I mentioned before, a lot of versatility in the types of things that we're looking at, and trying to find where we think there's a disconnect between what the market is expecting and what we think is going to happen, and that we have really good prospective returns.
Just on the book, this is just for interest for those that don't look at, I guess, hedge funds much, but often they're quite specific on the sectors. And I noticed there, for example, no mining companies, no energy companies, and that's not by accident. Those are and I think no financials. Square's slightly different, perhaps. What's your philosophy around some of those sectors that are perhaps a little bit more nuanced? Just put it politely. Yeah. I spent my career in a number of areas. I started off in a financial services focused fund. So it's, and that was balance sheet financials. And then I also spent a bit of time in the energy space when I was at Canadas Capital. And so I've had, and healthcare as well. So I've had a glimpse of some of the specialized sectors. And I made a very deliberate decision here that we were going to focus our time on areas that we thought that we wanted to develop significant expertise. And we thought
including the specialist areas, would spread us too thin. And those areas often also trade together, and as far as dispersion within the sectors, there is less potentially. And so it was a deliberate decision to focus in on these areas that I think have amazing rapid change. Right now in consumer and tech, there is so much change. And that change is happening at a speed that the world has never seen. And COVID-19, if anything, has made that dynamic even more powerful. And so there's winners, there are losers. The winners are big winners. And there's a huge amount of opportunity to see big market cap appreciation. And we've already started to see it. And it happened rapidly. And there's companies that are just going to be torched by the reality of the new world. And so we think it's really fertile ground to be investing. And we think because we focus on these areas and we're not being distracted in some other areas, that we're going to be able to mine appropriately and thoughtfully so that we're generating the best risk-adjusted returns.
Yeah, it's interesting. I mean, you can try and be all things to all people, but often sticking to your specialty, and the fact that consumer business services and TMT covers so much of the change that's going on in the economy, you kind of don't need to also be there. And there's plenty of ways to make serious returns without it. It's without having to worry what OPEC are doing or things like that.
Totally. And we're very happy with how the returns have been, and we think if anything, what's happened with COVID-19 has made the ground even more fertile, because it's just all of that change is happening faster, and adoption is picking up even faster than one would have expected. And so it's these sectors are eating up the other sectors already. I mean, there's just a lot of opportunity where we're fishing.
Yeah, fantastic.
As far as our process, we spend a lot of time on this filter, which goes through. We need to find things that pass our business quality test, our management quality test, our visibility into trend. This is something we spend a lot of time on, is this thing called RTDA. It stands for real-time data analytics. It's where we're studying tons of digital footprints on what companies and consumers are doing to give us a sense for what's happening with trends, so that we can, in a sense, be counting cards at a casino, and in a way of knowing what's happening before earnings results. So we're evaluating risk, evaluating what we should be doing with our positions before catalysts. So we want to find things where we have a visibility into the trend. We want to have a strong variant view about the quality of a business, a lot of conviction, and want to make sure that our expectations are different from what other investors in the sell side are expecting. We're big believers that earnings revisions are what drive stocks for the most part, particularly in shorter time periods, but even in longer ones. And then ultimately, the most important metric is valuation. And that, where I mentioned earlier, we try to be very thoughtful around a free cash flow forecast that incorporates a lot of risk issues materializing. And we use a 7-year and a 2-year return to determine the value of a company, to Emerson point. And if we can get companies to pass this filter, then we can be very excited. On the opposite end, on the short side, we're looking for companies that fail this filter demonstrably, except for visibility into trend. We want the visibility to be working, but we want the variance to be below what people expect. We want the valuation to be higher than what we think is reasonable, and we would love it for the management team to not be. we often will struggle if we find an asset that's a tough asset, but then say there's a new CEO who's joined who's really good. And in our experience, that's actually turns out in most cases not to be a good short. Or finding a business that's a good company, but we think the management team is a little off. What we try to find is when we can check all of these boxes, that's when we want to deploy the capital. And that's kept us at a lot of trouble, is by focusing on these things.
Amir, one of the interesting parts about RTDA or real-time data analytics is, I guess how out of the box thinking you can be. And correct me if I'm wrong, I could get this wrong, but one of the examples was, I think it was for one of the retailing companies you looked at, you could get analytics of how much tonnage of trash that they threw out each week or something, which would give you a good indication of, because I guess if you're chucking out trash, those are all the packaging boxes, so you're selling more. Is that the kind of thing that you're looking at?
Yeah, I mean, it's a ton of stuff. I mean, that's one fun example of things. We were, this was a dollar store that where you had a vendor that was a waste management vendor who didn't touch all of their stores, but touched touched thousands of their stores. So it's a representative sample, and you can get a really good sense of what's happening. And there's a lot, because it's in the ethos of what we've been doing and a focus for us, we've been turning over rocks in the most random areas. Like in the case of this waste management vendor, we basically wrote the contract with the waste management company. They hadn't sold the data before. So, we're the ones hunting around, trying to find new things that can be utilized to help us. And that's been a really big fun part of the process. And sometimes we get really unique things. Sometimes we find things that other people have found, but we always make sure that we're on the bleeding edge of where the data is, and making sure that we're there. And then we automate it so that it's flowing into our data, like our data lake for each of the different names is in that data lake, and we can see how companies are performing. And each Wednesday, the team has an automated report that each individual sends to me. There's a little bit of manual things they have to do, but they send to me that has, for both names in the portfolio, out of the portfolio, how they're performing across the market. And it's a very impactful and useful information to give you a sense for what's happening in the world. So in April and May of 2020, we got a lot less bearish because we were looking at weekly data saying, wow, like even though we're in the heart of the pandemic, all of these people are spending like drunken sailors on e-commerce. And it's not just it's not anecdotal. It's in the data. And then that led us to cover a lot of our short exposure for names that were particularly going to benefit, and then go long. Like we bought a lot more Etsy in 2020 because we said, look at what's happening. And so the data that we're hunting for, finding, and then incorporating in our process is a really exciting way to generate alpha. And it's kind of a fun statement to say you're counting cards at a casino. It's an overstatement, but it's indicative of how we feel sometimes. And, in a world of uncertainty, in a what I'd say is a difficult thing to do, which is to predict the future, you want every tool in the tool belt being in that tool belt, and what you're doing when you have it there.
I mean, that's just fascinating, because I guess, people like Buffett have been doing this for years, but they didn't have the data. They were, I don't know, or the perhaps a better example is the Walton walks that you sort of talk about, and the fact that the founder of Walmart would walk through the store and look at his own store, and then all of a sudden perhaps young analysts were doing the same and seeing how many people were in stores, and now you can do that at a much more supercharged level with the data, and people give a lot of lip service to data, but you're actually using it in real time to think about how your portfolio of companies are going. And I think it's gone are the days of I'll download some credit card data, because as you said, everybody's probably got credit card data.
Yeah, totally.
So it's around evolving what the type of data you look at. I think it's and the fact that not everybody does it is just really surprising, given the availability of information.
Totally. And I have to say, the Walton Walks, that's an important part of this, is that we marry the data with on the ground information, because we don't believe that you can do one without the other. It's very dangerous using one without the other. And so that's another important sort of nuance to this is we have a fundamental due diligence process. At our core, Emerson Point is fundamental due diligence. It's, I think 5 of the 6 of us have private equity background. However, so we're going to utilize Walton Walks and spend time at the companies and talk to customers and walk stores and do focus groups. And we do all that stuff, I think, as good as anybody. But what we also do is take some data that helps us ask better questions when we're in the store or doing the focus group, or utilize that to really create this hybrid approach that I think has been really helpful for us. It's both.
Absolutely. I went to a Sohn conference in New York, and one of the chaps who got up to talk about a stock was 18 years old. I mean, fundamental analysis can be done across the board, but it's how you use that alongside other things that are available, like data, and going through the different. You would have seen multiple cycles of the companies that you look at and how they report, and when the management philosophy is of, over-promising and under-delivering and earnings announcements and things. It's a whole mosaic of different things, not just punching a DCF model into an Excel spreadsheet and investing.
Totally. And that reminds me, James, I'll be presenting at, it's a equivalent of Sohn, but it's called Invest for Kids in Chicago in early November. I've been meaning to send you an email, but I was asked to present. And so it's a similar setup. It's virtual this year, but it's essentially, the Chicago version of Sohn. So I'll make sure that either myself or Siddharth will send you information in case it's something you're interested in. It's a number of managers presenting best ideas, same idea as Sohn.
Fantastic. Yeah, would love to. Thanks, Samir.
So happy to really go in any direction you want. I think as far as slides go, I think we hit kind of the high notes. Happy to answer any of your questions, give a high level view on the market, talk about any themes that we like right now that are being expressed in the portfolio, or whatever you think is a good use of time for folks.
Yeah, I'd love to get your thoughts on how you're seeing the market at the moment, and then perhaps more importantly is how that's reflected in some of the themes, because I think there's it feels like we're almost at a tipping point around it's hard to say this when I'm sitting and not allowed to leave my house other than to do a bit of exercise, but that COVID is starting to slowly get behind us. Economies are starting to open up. What next around the investment landscape, and then what are the companies that you're looking at to generate the return targets that you're looking for?
Yeah. So few things right now. The market has had, September was a tough period for the market. So kind of evaluating what that potentially means. It's been a great year, and it's been a great time since March of 2020. So few different things we look at when we sort of evaluate our, how much risk appetite we should have, is we start from kind of the negative view of or evaluating whether we should have a negative view by saying, what are the elements of things where we could see permanent capital loss? What are the categories? And in general, the categories we look at are A, are valuations stretched? B, what's the Federal Reserve doing? C, what is government policy doing? Is it shifting towards socialism? D, is the world in some type of conflict? In this case, it's COVID. And then lastly, what's happening with inflation? Some of these are connected, but these are the categories we spend time thinking about as we're evaluating whether there's concern. And so as far as valuations, I think that there are pockets of the market that are overvalued, but generally we do not view that we're in a bubble. We don't. We think the valuations are, for the most part, reasonable. Equity risk premiums are reasonable. We think that there are some pockets of overvaluation, but in aggregate, the types of businesses that are deemed overvalued, we think in many cases have earned those valuations, such as in the software space. And so and as we run our long-term models, we don't scratch our heads when we look at the companies in aggregate. Certain companies we do, but not in aggregate. So in general, we'd say, are we in a bubbly environment? We think things are fine, especially after the last month of knocking some froth off. So we say, topic A, fine. You know, it's not like things are cheap, but it's not a bubble. As far as the Fed, topic B, we think it is, they're tapering, they're planning on tapering, but it's still stimulative. Rates are low, the Fed is still stimulative. We think ultimately the score here is fine. We have to see if things evolve where, you know, as we get closer to, say, the end of taper and, you know, a rate hiking cycle, we can be evaluating it as it is. But right now, we would say that the Fed's policy is accommodative, so positive. So again, we've got two fines. And then as we look at these others, government policy. In the US, there was concern that we had that with the change of administration and the Democrats sweeping Congress, that potentially that we could have a shift to the left, which could result in overregulation and maybe excessive taxation. But what's happened is that it's been gridlock in Washington. And so we think the score here is fine as well. If anything, it's shown that the country is really, the government is really split. And again, that score is fine. That they may get an infrastructure bill done, but they're not going to do anything that's out of left field. And that, I think, is relevant for equity markets, CEO confidence, SMB confidence, all of these things that can help the economy, which is an important backdrop. Topic D is there a global conflict? Now, the big global conflict has been COVID. And now there's always rumblings of other things. Of course, China, Taiwan, question mark. For the most part, the big topic is COVID. And we think that COVID's in its last legs. And maybe we don't think we're being overly optimistic. We think that we're at this point where we've got the tools as a society to cope with this, and that we're at this amount of time that's passing that we've learned these tools that can help us, whether it's the vaccines or the Merck antiviral, or ultimately the increase in testing. And we think that though we're not out of the woods, much of the world, we believe, is in the last legs of the crisis. And so the war there we would score as fine as well. And then the last thing is around inflation. So all the other things we look at are fine. The last thing is inflation. And that's one where we're a little bit more concerned because things have been running pretty hot. The government was giving a lot of money away. Consumers, because we're spending a lot of time doing focus groups and talking to consumers, consumers are flush with cash, at least in the United States. The savings have gone up. A lot of them got government checks. A lot of people have money in the stock market. People own Bitcoin, stocks, and of course housing, which is the big asset in the U.S. Housing prices up 20% year over year. It's a levered asset. So think of some people's equity in their home has gone up 50% in the last year. And so really a hot economy coupled with a lot of demand. Americans in particular, when they get money in their pocket, they want to spend it. And so they're going to the stores, they're trying to buy more. And at the same time, you have supply chain issues. And some of the supply chain issues are COVID related. Some of them are just related to excessive demand stretching a supply chain. And so right now we're seeing prices go up in a lot of places, food prices. And then the latest concern has been around oil and gas and commodity prices. That's the area that we get a bit more nervous. Out of our categories, we're a bit more nervous about where inflation sits, particularly because it could impact what the Fed has to do. And that could really complicate things if out of this group of 5 things, 2 of them turn negative. Then we'd have to be a bit more concerned about our risk appetite. All in all, what we think is that things are fine because out of this, 5 of the 6 are fine. 4 of the 5 are fine. All but 1 is fine. Things aren't perfect, but they're fine. We got to keep our eye on inflation. There is an argument that a lot of this is temporary. So, it's not like we're in a really tough spot, but we got to keep our eye on it. And we should just be picking our spots. And ultimately, if we pick our spots well, the backdrop of the market should be supportive. And as we go through things like earnings season, things will be rewarded for picking our spots appropriately. So that's how we're thinking about it right now.
I think it's a great summary because you can often get way overly negative in these scenarios. You can always pick a narrative to get down, and you want to exit the market, go into cash and wait things out. But actually, if you methodically go through each of the risks and then reflect on the companies that you can invest in, actually things look pretty good. And yes, I'm perhaps talking your book and our book a little bit, but in this environment, if you're an active manager rather than just buying in the index, actually the opportunity set is still really strong. You just have to go looking for it a bit harder.
Yeah, I think we're still in a young bull market. I do. Now, if the facts change, our mind will change. If there's a change to any of these categories, the team here is following these things closely. If some of these things flip, the war element switches and there's a new variant that's really concerning, or say Jay Powell doesn't get reappointed and Biden appoints someone who's really concerning to us in the market because they're, say, really far left of center or something, where we then have to question, is the Fed going to be inappropriately dovish, which then raises concerns about long-term inflation, which then impacts long-term interest rates, which then impacts all the high-quality companies that are longer duration assets. There are facts here where we could get negative. But based on what we see, we think that for the most part, the answers to these questions are fine, and that the right thing to be is deployed, but cognizant that there are risks, follow closely. And if the facts change, our minds will change. But currently, things are okay. And then that enables us to then say, okay, we're in a fine environment. Let's get back to it of picking out the themes and the companies that are doing great and that are underappreciated in their return profile, such that the market is not pricing them appropriately. And in general, that should be that's a great place to be in. But again, if the facts change, then we'll have to reevaluate.
Well, I mean, I've just realised the time. It's these things always go fast when I'm enjoying myself. I think that's a fantastic summary of what's the state of play at the moment for both the market, but also where Emerson Point Capital fit within that. The themes that you mentioned are, I guess, quite obvious in the sense when you look at actually the stocks in the portfolio, and they vary, but they're all changes and bring about change within the certain different sectors that they play in. Is that a fair enough sort of really fast summary of how you're thinking about the themes at the moment?
Well, I'll give you three themes that are top of mind for me, and I think that are indicative of types of companies we invest in. The first theme is we want to invest in companies that are going to be stronger coming out of COVID than they were coming into COVID, because they're able to become much more efficient businesses. And they're strong businesses, but now that they went through COVID, they're going to be stronger. And the poster child for us is Live Nation, which is, they own Ticketmaster and they dominate the live music industry. So it's a reopening company, but this company is cut out 20% of the EBITDA base from 2019. 20% of it of costs they've permanently cut out. So EBITDA should be 20% higher than the past, because it was essentially a monopoly business. They were running it pretty fat and happy before COVID. But because of a near-death experience, they've had to become a better business. And we want to invest in businesses that are already great businesses, but then are becoming even better, because those businesses can then surprise people. Live Nation is an example of that. Expedia is an example of that, and Airbnb is an example of that. It's amazing what a near-death experience can do to a company. All of those companies had near-death experiences, and they're coming out what we think are going to be really destroying margin expectations, because they can be much more efficient. Then the other theme that we think is helpful is we really like these businesses that are stronger coming out of COVID because their competitors are weaker, and their competitors the pandemic was not good to them because they were small and undercapitalized and not digitally savvy. And the biggest examples for us is Chipotle, which is our biggest position, which is a fast casual restaurant chain predominantly in the United States that is a digital leader. Half of the sales are digital, and is getting the best locations now because so many restaurants have closed and consumers have fallen in love with the digital capabilities. And so they're picking off the best locations. And the other example is Floor & Decor, which is a company that we liken it to Sherwin-Williams 15 years ago, which is the big paint company in the US that's been a home run stock, or even Home Depot in, let's call it the late 80s or 90s, before they really started to roll up the mom and pop home improvement industry. Floor & Decor focuses on flooring, rolling up the mom and pop industry. The mom and pops have gotten decimated by COVID. And in this supply crunch, the mom and pops are even more hurt than COVID hurt them, because they can't get product. And the larger players like a Floor & Decor can actually get product. So again, it's a business that we think will surprise people, will come out of the pandemic stronger than it was coming in. And then the last thing is we want to help companies that help other companies do better, particularly small businesses. And we think that tied to this whole concept of companies that are poorly positioned from the pandemic, a lot of small businesses were put in a really tough spot. And the companies that are empowering those small businesses are going to get a lot of business in the next few years, as the companies that have survived are reimagining how they can compete in a more difficult post-COVID world. And those companies that we're invested in are the businesses like Square, which is helping automate how companies take payments and manage their back office and manage their people and all of the things at a very reasonable price to enable an SMB to have a product and an experience that can compete with a big retailer like a Floor & Decor or whoever, or a Chipotle. And then a business like Bill.com, which is helps automate the whole back end of the accounts payable and accounts receivable of an SMB. And again, those are functions that before an SMB was spending all of their Sunday grabbing the paperwork, grabbing the filing, wasting all this time, not thinking about their business, but herding cats. And instead they're going to say, hey, why don't I spend $2,000 a year buying Bill.com? And so for us, we're looking, these are some of the themes that we think are really going to be important, is we got to find these companies that are going to be better coming out of the pandemic or helping companies become better coming out of the pandemic. And we think there's just so much happening there that there's a lot of interesting opportunity.
Well, Amir, what a great place to stop. That's what a fantastic summary of the different themes. It does make me excited when you realise the opportunities out there, and not to get too disjointed by the Bloomberg headlines of all the doom and gloom that seems to be running across media at the moment. Huge amount of opportunity, and we're really grateful to be partnered with you to take advantage of those. So look, on behalf of everyone here, thanks so much for taking your time, Siddharth. Thanks for your time as well, and really appreciate your thoughts, and really great. Looking forward to the remainder of this year, but also what 2022 has to bring for the portfolio, and we're gladly invested alongside you.
Thank you so much. We appreciate the confidence and support. Have a wonderful day.
Great, thanks. Enjoy your rest of your weekend.
Thank you.
Look, we've just run on 10 a.m., so we will leave it there. But what I would say just before we finish off is that in the investment insight that we published on Friday called Global Investment Partners, what we've done is we've summarized each of the global managers that invest our clients' portfolios. One of them obviously being Emerson Point Capital, the other long-short manager being Sabretta. Then we discuss our long-only managers, Fisher and MFS, and also touch on Universa. And obviously the aim is to get someone from each of those investment firms who we've been invested with for quite some time, other than Fisher, who's just joined the gang, to come and have a talk just like Amir did around how they're seeing things. But I hope that gave you a great insight into Emerson Point Capital and why we like them. We think they are a really, really great fundamental share portfolio, both on the long and short side. And we think it will do well in any market environment, which they have done. So thanks very much for listening in this morning. Have a great week, everybody, and join you again same time.